Good afternoon, everyone. Welcome to our first Wednesday market review of 2020. My name is Stock Darts, and as we normally do, we'll go ahead and take a look at the four major market ETFs. We're going to look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. We'll do so using their most commonly followed ETFs. Once we finish that, we will then take a quick look at the US dollar, see how gold and silver are behaving according to that, and then take a look at oil and see if anything like that, any kind of commodities are giving us a clue as to what the market is doing. After that, we will go ahead and take a look at any chart requests. If anyone that's in here has a chart request, feel free to put it into the chat, and we will go ahead and take a look at it as soon as possible. Other than that, let's go ahead and get started. If you like what you see here, you can always look for more content. Follow me at Stock Darts at Twitter, Stock Darts on YouTube, or you can visit me at patreon.com/StockDarts, where I post weekly blog content. Typically, I give you watch list ideas and potential trades that I'm looking at for the week, as well as reposts of these Wednesday market reviews. So other than that, let's go ahead and get started. First thing we're going to do is take a look at the ETF SPY and look at the S&P 500. Now, we are actually having a good day today. We started off the year kind of consolidating. Volatility has increased a little bit, and we did chop back and forth, but for the most part, there's still a lot of demand here, and the markets are still doing very well, and we didn't really get too much of a pullback. It's interesting because if you look at it intraday, looking at, say, a 5-minute chart, as most day traders do, you would have seen that there was some decent selling pressure coming into the markets over the last week as we started off the new year. But we've been finishing strong, and we've been doing a good job of overcoming that and finding buyers right away. And at the moment, it looks like the market wants to go ahead and start pushing higher, and as if the consolidation that we got was basically all that the bears had, at least to start the year. Now, I do think that at a certain point, we're going to need to see a little bit more substantial pullback. We've had a pretty nice move. If you look at where we were back in November and what we've done since then, you can see that we've climbed pretty steadily. And even though we did chop around for a bit as we hit the end of November, beginning of December, we did end up having a nice holiday rally when you look at the last 2 months of the year. And we did have a pretty strong close. And as we've started this year, so far we haven't given back too much of that move. And if you just go ahead and take a look back and you figure, well, we've moved from 302 to 325. And we really haven't come back and had any kind of substantial pullback other than maybe this 1 or 2 week sideways move. And particularly when you look at what we've done from the middle of December to the end of the year, we haven't really retraced that. And a lot of times when you get this kind of price action that starts to slowly drift upwards, you typically get a correction of some sort as you shake out some of the weaker hands that are chasing the price action upwards. And at the moment, what we got over the last week might be all that we're ready to see right now, but I do think that as we move further into January and as we start to approach maybe February, we should start to see a little bit more substantial pullback and a little bit more consolidation to kind of counterbalance the strong move that we've had over the last 2 months. Typically, when you have a stock market that's doing very well, you'll still have some pullbacks and you'll still have some moments of consolidation where traders take profits, or you just get that point where you need the shares to exchange hands and you need new buyers to sort of take up the mantle or the torch and then be the ones that continue to drive the rally upwards. And at the moment, I think that's kind of what we need, or maybe what we just saw. But if you take a look at the four major market ETFs, which of course we're going to do in a second, we are starting to get pretty bullish action, particularly on the S&P 500 and the NASDAQ. And it looks like the market wants to attempt to keep rallying upwards and try to figure out exactly where the major levels of supply or resistance are. And so that's really what we're looking for right now. I think, again, we are in a market that's very strong, and we should be looking to trade upwards. We should not be looking to short. The only people that should be looking to short this market are day traders. And even then, they're probably having a difficult time because there are so many strong pockets of buying that we keep running into. But if you're a swing trader, you should be looking to trade long right now. You should not be looking to short this. This is a conversation we've had pretty repeatedly over the last 2 or 3 months and really over the last several years, which is, you got a lot of traders that look at this market and think, well, it's due for a pullback. It's due for a letdown. We need to drop at some point. And yeah, that might happen at some point. But when you have a market this strong, it makes no sense to try to fight it. Even if you're anticipating a pullback, the best idea is to just wait for that pullback to occur and then buy that dip, and go ahead and take advantage of the current of the market and the direction of the market. But what you're doing is you're getting better price. You're getting a better risk reward or better price on whatever equity you're trading, because you're waiting for it to come back into support. And if you do time it perfectly and you do catch the right short, you're still only catching a small temporary pullback in a larger uptrend. And more often than not, you're going to find yourself in a position of trouble, because buyers are going to typically jump in ahead of what you expect, and ahead of whatever target you had in mind for your short trade. So at the moment, I'm going to recommend just trading to the long side like I've done for quite a while now. And really, it's a matter of identifying where the market is and what types of trades are working. It seems like over the last couple of weeks, the best trades have still been support trades rather than breakouts. But if we continue to see the markets break higher, then I think we can start looking at breakout trades and continuation trades off of bull flags, and see if they start to behave a little bit better than maybe what they did over the last couple of weeks. And they did work pretty well throughout November and December. And I think at the moment, one of the keys is really identifying areas of the market or pockets of strength as the markets try to climb higher. One theme that I noticed when I was going through potential trade ideas on Monday was, and for those that maybe aren't aware, every Monday I tend to go over 500 to maybe 1,000 stocks, looking at potential trade ideas. And I get a pretty good view of what the market's doing just looking at those names. And one thing I noticed was that there were a lot of names that weren't really presenting good risk reward, because they had either broken out or had some failed moves as the market started to pull back. And despite the fact that the market was still holding up at highs, there were a lot of names that gave up some of the moves that they had throughout November and December. And so it became an issue of trying to find a name that gave us good risk reward, and was maybe sitting in a different place from the market. But despite the fact that the market is at highs, there's a lot of individual names that are not, or that have already sort of undergone a little bit more prolonged corrections than what we've seen in the market. And so what we want to do at this point is we want to identify what type of environment the market's in, and then try to find names that are maybe giving us more profitable entries or better trade setups than what the market's giving us. And that's how I've sort of approached the last few months, and how I'm going to continue to approach it. And that's really the basis of what we're doing on these Wednesday market streams, is trying to figure out what environment we're in and where we're going to go from here. So again, I think the market looks like it wants higher. Obviously today we've already pushed to new all-time highs, and if you look at what we've done, I know I've kind of spent a little bit of time talking about stuff other than the market, but I just wanted to give you guys an idea of why we're looking at what we're looking at. We had a nice... So we're going to put a couple trend lines here just to give you an idea of what's going on here, right? So the market was, and actually we'll reappropriate one of the trend lines first. This is how we ended last year and how we started the year, right? We're basically drifting higher, creating this ascending wedge, right? And we finally had some volatility come into the markets, as I explained earlier. We had some chopping back and forth, and what ended up happening was we found a new level of support, right? We found where the buyers were willing to step in and support the S&P 500, in this particular case, right around 320 in the short term, which ended up being pretty close to the 20-period moving average. Now, with today's price action, we were able to break past what ended up being maybe a 4 or 5 day correction, right? You could look at it in this respect as well, where once we reached our highs around 325, we had a couple of drops, but you'll notice again, and we're going to go, let's go into, say, a 1 hour chart for this. You'll notice what ended up happening in these particular days was that we had some selling pressure come in, and then we'd close strong. We opened down, we closed strong. We opened down, we would close or move upwards strongly. And so what ended up happening was that we were pulling back. We were encountering resistance, but the buyers were still stepping in and supporting the market. And then with today, of course, we've got the breakout, which is a little bit of a difference because we didn't open weak like we did the last 3 or 4 days. Instead, what happened was we actually opened strong and have started to climb upwards. Moving past, in particular, this 3-day consolidation, right? We've got this 1, 2, 3 days, and we finally broke out. So the market is starting to make its way upwards, and exploring higher prices, and it's overcome basically this big consolidation that we had over the last week or so. Um, let's get rid of some of these trend lines now and get a cleaner picture of what's going on as we go back to the daily chart. Alright, so that's where we stand right now. The S&P 500 is doing a good job of breaking higher, and I think at this point what we want to do is we want to identify the key levels that we can look at that'll give us a better idea of what we can judge that the market is, what type of price action or environment we can judge the market to be in, depending on what levels we identify, right? So the first level is what we just looked at, this 320. As long as we're above 320, you can say that the market has already found the level of support that they want in the beginning of 2020. And as long as we stay above that, then we should expect higher price action. If we drop below that, our next level of support is going to be down here around 314, which would be right around the 50-pair moving average. And I would not expect price action to really fall below that on the first attempt down. That's, again, we're in a pretty strong bull market. We have not tested the 50-pair moving average since maybe last October or so. So the first test of that moving average, is we start to trend higher, is typically going to be met with a lot of buyers that are going to want to continue to push the price action upwards. So for now, we could look at the 50 as probably the lowest we would expect the market to pull back until we start to see some more negative news or negative issues that could impact the market, which I don't think we're seeing at the moment. Now, and you would think with potential war looming with Iran that the market will be more scared, but when a market is very strong like this, it tends to ignore news, at least in the longer run. Sure, you know, the last couple of days we dropped down with overnight news, but then the buyers came in and looked at it as a buying opportunity and supported the market through the poor news, and that's why we continue to have these sort of big moves up throughout the day, is because the buyers trust this price action and they want to be long, right? And the market is looking to figure out where the sellers are, and it has not found enough sellers yet to really stop it. So as far as levels to the upside, well, we're obviously right at a key high, which is all-time highs. If we are able to push past that, I expect us to probably ride the top of this trend line for a little bit longer. I don't expect price action to really push past that, so that's maybe a key for you if the market starts to get a little overextended. But more likely than not, what we'll do is we'll push up a little bit higher and then come back and test it and start to really ride the 20-pair moving average until we find enough sellers to push it down. And so those are the key levels, really. I don't want to get too crazy pointing out a million different levels on the S&P 500. I think that with the market as strong as it is right now, we only have to look at the shorter term levels. Longer term, of course, this area around 302 is a very critical level. Another area around 307 is going to be a pretty important level, and further down around the 200-pair moving average. But I don't anticipate price getting to those levels from here to next week, or even from here to the end of the month, or maybe even not into February. You know, just the strong price action that we're seeing right now, I think we need to concern ourselves with the short-term levels. And if we're going to hit these long-term levels, we'll be able to notice that once we start to struggle with these shorter-term levels. So at the moment, really, if you're looking at the S&P 500 and you're looking at support levels, I think 320 and then the 50-pair moving average, which will likely be somewhere in the 315 area, if price comes to meet it, are the two key areas to watch. As long as price action stays above that, we're fine. If price action falls below 315 and below the 50, then we start to look at 307 and 302, but that shouldn't be the case. I think unless some real drastic news comes out that really shifts the market attitude, we're probably not going to lose 320 from here to next week, and if we do, we certainly most likely will not lose the 50-pair moving average. Now, one thing that I will point out is if we do come back and test 320, that might not be a very good thing because we're going to end up with a pattern kind of like this, which is kind of a topping pattern. There's not a lot of ways of looking at this and say, well, it's sort of a triangle and it's going to drop. But you can look at it almost like a head and shoulders forming, where you have a move up and then a drop and then a move up and then a drop. And then so the next case would be another move up that falls short of the highs and then a drop. And then that would likely be sort of like a head and shoulders pattern that would indicate that the market is finding way too much resistance or too much supply to overcome, at which point then maybe we come back and test the 50 or even head a little bit lower. So I'm not really looking for a test of 320 right now. What I'd like to see out of the market is another move upwards, and then from there, if we do pull back, we pull back and we test and we sort of maintain this trajectory. And if we can maintain this trajectory, then I think the market is in a pretty bullish stance. And again, we should be pretty aggressive buying to the long side. If we come back to the 320, I'm not advocating a change to a bearish stance. All I'm saying is be a little bit more careful and make sure that you're buying support rather than trying to chase action higher, or even just play momentum higher. All right, so that's the S&P 500. If we take a look at the NASDAQ, it's a very similar picture, but with a little bit more bullishness, because the market right now, the tech names are starting to get some relative strength, and they're starting to outperform again. And you can see that with the Qs, we actually started to break yesterday, break higher, and then with today's action, we actually have a pretty strong continuation. So it seems like the NASDAQ is maybe a day ahead of the rest of the markets and is pushing upwards. This is something we anticipated. We've been looking at tech names. For those of you that follow me on Patreon, you'll know that we've been looking. We actually had a trade at the end of last year on Amazon that has worked out very well for us, from down here in the 1750, 1760 area, and it's made its way well past what our initial targets were, and continues to climb upwards and make up a lot of lost ground. And you'll notice that it's not just Amazon. A lot of the FANG stocks have actually performed very well throughout the holidays and continue to perform well as we move forward into the start of the new year. And so what we're seeing here is a lot of them finally get their acts together and start to climb upwards and start to make their way higher as they sort of overcome some of these stronger price corrections that they had in September, October, and even at the beginning of November of last year. So the FANG stocks are starting to improve, which of course is reflected pretty clearly in the Qs. And that's one of the things that is leading to the NASDAQ and the Qs in particular, leading the action higher at the moment is the FANG stocks. And I think in general across the board, a lot of tech names are doing pretty well and moving upwards as well. Now, as far as the analysis of the Qs, it's basically the same as what we have on the S&P 500, right? So we have our short-term level here. You can see the last couple of weeks we pulled back to 211 and then just short of 211 around 212. And each time we found buyers and we're able to push the market upwards. And we have a very similar situation where we're just kind of, the channel isn't really formed at the moment, but you can see there's a nice upwards trajectory. And what we want right now is we want the market to maintain this trajectory as long as it can. That way, once it does pull back and break through it, we don't have that scenario that I just pointed out on the S&P 500 where we have this sort of topping pattern with 210 as sort of a little neckline. It'd be more ideal if we continue to break upwards, and then when we do pull back, we have room to find buyers that are willing to support price action higher than this 211. Now, again, if we come down to 211 or 210, that doesn't necessarily mean that we're rolling over, but it's something we need to look at and then figure out whether there's going to be a pullback down into the 50 period or whether there will be enough support here to maybe extend the price action. We could get something like what happened in November, but ideally right now, if you're bullish, you'd rather we maintain this upward trajectory, and that the pullback and the correction we had over the last 3 or 4 days is basically it as far as January is concerned, or at least as far as the first couple of weeks of the year is concerned. Other than that, really, if we lose 211, there's still the 50-period moving average, there's still this 205 level, and then more critically, way back here at 195 is the real critical level, at least in the long term. And you know what, I didn't look at it on the S&P 500, but we'll go ahead and look on the NASDAQ at the weekly level. And you can see very clearly that what we've done this winter is having a full-fledged breakout, and we've left this base that we spent the last couple of years in behind, right? And so even if we have a very drastic pullback over the next month or two, as long as we hold above 185, 187, 188, we're in good shape in the long term. And if you take a look at the S&P 500, it's the same story. We have a lot of room to pull back and still be in a healthy market in a longer term picture, right? So we're all the way up at 325. We could drop all the way down to 295 and still be in a healthy market that's doing what it should be doing, which is breaking out of a base and then coming back and retesting before it wants to move upwards. So there's a lot of room to pull back and still be in a bullish market. That's one of the reasons why I've been advocating to play to the long side and not play to the short side. Is we're very clearly in the beginning of what could be a very strong rally. This is something that I harped on a lot last year, and was really trying to make sure that traders understood, is that we could definitely be in a situation like what we had in 2017, where the market just climbed relentlessly throughout most of the year, or a similar situation very similar to what we had way back in 2013, 2014, where the market just climbed all year. It just never stopped. And that happens after you have these big bases. Eventually, when you leave them behind, you have what's considered a markup phase in the market, where the market just starts climbing higher as it looks for the next level of real strong resistance, right? And so we have a very similar situation here. So, for now, you should trust this market. You should trust this price action. And you should continue to take advantage of it. These situations don't come around that often. And for traders that struggled over the last couple of years, these are the types of markets that really let you survive that, right? You're supposed to make more money during these markets. That way, if you lose money during the chop, you're okay because you're still ahead because of the big climb that it had right before it. So we want to go ahead and take advantage and make sure that we understand that if this year is going to be similar to what we saw in 2017 or 2013, that we're not wasting our time trying to call shorts or trying to doubt this market, that we're trusting the price action and we're taking advantage of it as it continues to climb upwards. And so keep an eye on that. Now, it could end up being different, right? We could end up maybe that we find that we reach highs very soon and the market rolls over. But if that's the case, we'll understand, right? You don't want to call shorts. You don't want to try to short the market when it's here at highs. What you want to do is keep an eye on it, right? If it starts to lose this trajectory, then we start to doubt it, right? If it starts to lose the 50-period moving average, then we start to doubt it a little bit more. If it comes back down to 195, well, then at that point, we're like, all right, maybe we're wrong. Maybe this is a market that we need to start looking at playing differently. But until it starts to lose all these different warning points that'll give us better ideas of when the end is, we shouldn't just anticipate that the end of the rally is coming just because the market's at highs. If anything, we should understand that the longer the market is at highs, the more likely that it's going to continue climbing upwards. And again, if you look at the longer-term picture, you can see that we've had a very important and pretty critical breakout from November to December of last year. And at the moment, we're just continuing that upwards. And until something changes, we really shouldn't doubt the type of price environment we're in. And we should go ahead and make sure we take advantage of this price action. Now, that doesn't mean chase it higher, right? So if you're looking at the Qs right now, you wouldn't want to buy this at this point. That would just be foolish, right? You'd just be chasing the price action upwards. You'd have terrible risk reward, terrible timing. The market probably at some point will have to pull back as it, even if it comes back on and maintains that upwards trajectory, it can still pull back 4 or 5 points and put you in a bad situation where you're underwater on a trade just because you got impatient and you tried to play to the long side a little too early or a little too late. So we still want to look for the right risk-reward opportunities. But when you have a market like this, even though it's not a good idea to buy the Qs right now, there might be some tech names that it would be a good idea because they give you or they provide you with better risk-reward. So for instance, we could look at a couple of the names that I provided to my traders this week in my Patreon.com blog. We looked at a couple of kind of gourmet burger names, right? So we looked at Beyond Meat, and you can see this is a totally different story. It's in a much weaker state than what the market was in, but it gave us good risk reward, and there was a very decent trading opportunity if we got a breakout. This was the type of trade that I recommended only trading once we saw full breakout. We wouldn't want to trade this in anticipation of a breakout, but we've got about a 10-point move just in 2 days. The other one we were looking at in a very similar state was SHAK, which is starting to break out today after threatening to break down yesterday. And so even though these names are not in the same strength or the same place that the market is, they're still taking advantage of the upwards momentum that we're seeing in the overall markets right now and provide us with pretty good risk-reward opportunities, right, where you're only risking maybe 2 or 3 points of downside for a good 10 to 15 points of upside depending on which of the two names we're looking at. And so what you want to do in these situations is, and I'm not saying necessarily you need to buy value names like this. You could look at names that are trading bull flags. If you really despise buying names that have had this sort of weakness in them, you don't have to look at names like that. You can look at names that have been trading with bull flags or tighter ranges closer to their highs, and give you better opportunities to trade the momentum upwards. But what I'm saying is you want to look at names that give you good risk reward and give you better setups than just trading the market because the market's at highs. You don't want to chase the price action. You want to make sure that you remain disciplined and you don't make mistakes trying to get overly excited about this market. I think we're in a very good market, and it's a market we want to be aggressive, but you don't want to just abandon, and just become reckless and abandon all discipline just because the market's going up. The market will erase a lot of mistakes, but it won't erase all of them. Wes, good to see you in here. We will definitely take a look at your three chart requests as soon as I get through the gold and silver oil part of today's stream. All right, so I've spent enough time with the Qs. Let's take a quick look at the Dow Jones. And you'll see, very similar to the S&P 500 and the NASDAQ. Now, you'll see a little bit of weakness, right? It's not at highs like the other two. It's pretty close. It printed the same form, though, or the same kind of trading pattern, right? Where we had a 3-day or 4-day pullback, and then we're finally starting to break out. And same sort of pattern. We're bumping up and trying to rise above the 20. Still well below the 50. Well above the 50. And it's the same idea, right? We've got horizontal resistance at basically the same relative point, and we've got the 50 underneath, and then way down here we've got this 273 as kind of the longer term level that's important. And with the Dow Jones, we even have another level way down here at 265. So in the long term, everything's healthy. In the short term, we're looking pretty good. A little bit weaker compared to the S&P 500 and the NASDAQ, but overall doing very well. Really, everything I said about the S&P 500 and the NASDAQ applies to the Dow Jones, so I'm not going to spend any more time on this one. All of the same points, all of the same relative points make the same, have the same impact and make the same sense depending on what I mentioned with the S&P and the Qs. Now, the one index that of course is different is IWM and the small caps of the Russell 2000. And you can see as we pulled back, there was relative weakness on IWM compared to the other two. Not surprising. Not surprising that we haven't broken that pattern yet. You can see a much clearer pullback on IWM compared to what we saw in the S&P 500, the NASDAQ, and the Dow Jones. Now, that being said, I think this is still fine. I think we're still holding up pretty well. And the key here is, of course, for IWM to follow the other three markets and break past this consolidation range and start pushing back towards its highs. If we look at the weekly on the small caps, you'll notice we're not at all-time highs. We're not even really close to them yet. But there's still some substantial vacuum here for IWM to push through and to continue trying to play catch-up. And what we want to see in this scenario, and it hasn't happened today, or it started to happen, well, it hasn't really happened today, but what we want to see is we want to see IWM outperform at the very least on the good days, right? So if the market's pulling back, I don't expect IWM to hold up better than the other three. But what I'd like to see is on these days like today where the market's breaking out to new highs, it'd be nice if IWM was actually leading the way. It's not, clearly. You can see here we've got 0.7, 0.9, 0.7, and then we've got 0.57 for IWM. So it's the weakest of the four as far as its potential for today and its move up. But what we'd like to see is we'd like to see at least the relative strength come in on good days, even if it's going to sell off a little bit more strongly when the market does pull back. Now, that being said, the analysis is still very similar. We've got a level of resistance here. Now, you'll notice it's not quite as clear-cut as the S&P 500 and the NASDAQ. The previous resistance, we actually fell through, right? So if we're really making this line identical to what we saw in the S&P 500 and the Qs, then our support line would be up here around 165. Instead, it's actually down here somewhere around 163. That being said, the 50-pair moving average is still kind of critical. We're still not close to there. And even more importantly, this line here, this 158 to 159 level, this was the critical level that we had to really contend with throughout all of last year. As long as IWM's above that, I think that we're okay and we're in a pretty good market. If IWM falls back below that, I think that is one of the bigger warning signals that our market is not really ready to rally as strongly as maybe I'm suggesting. What we saw in 2013, what we saw in 2017. If IWM falls back below this, then I would expect that to negate the potential for that kind of a move. As long as IWM keeps climbing, even if it's slower than the other three indices, then I think that we're still, in a market that's all systems go and still looking to trade to the long side. And like I said, we have levels to watch, right? We understand that the market is strong. There is of course, the chance that we get weaker, but if we do, we understand where the levels are now that would warn us that the market is maybe losing momentum or starting to roll over. We've got our short-term levels, we've got our mid-term levels, we've got our long-term levels. As long as we understand that, we should be able to gauge pretty quickly where the market is and what type of environment we're in by comparing these four indices to what these levels are on these four charts. And as long as we're holding above them, trade to the long side. If we start to lose some of them, then be a little bit more cautious, but we don't really need to readjust our stance until we see some of these long-term levels being broken. In the short and intermediate term, we just need to be more patient and understand where value is and where we should be looking to buy the dip if we do pull back. And if we don't pull back, if we keep climbing higher, then we need to understand what types of momentum patterns are working and know when we want to go ahead and take advantage and find a way of manufacturing good risk reward by looking at small consolidations and using those as our stop out points. Okay, and if anyone doesn't really understand what I mean by that, feel free to just message me and I'll explain in a little bit more detail, or we could maybe do it through an email exchange or something. All right, so that's the four major markets. I think overall, like I said, the market is in a strong place, and we should not be too scared to trade to the long side right now. We should be looking to take advantage of upwards momentum, and there's a decent chance that we just saw the correction that we were going to see to start the year, and that the market wants to at least spend the next couple of days trying to explore higher. And then from there, we'll see. We're going to encounter more selling pressure at some point. I don't think that we've corrected enough to really say that we found enough selling pressure to offset the gains that we had, say, on the S&P 500. So if you look at the S&P 500 and you look at the gain that we've had, I don't know that we've pulled back enough yet to really kind of consolidate the move that we had upwards. But if you look at IWM, we've had a pretty decent pullback, and this is a pretty nicely formed flag. And if we could break past that, then we could get another leg up, and then we'll see where the next level is. But I think overall, it looks like the market has overcome the pocket of selling pressure that we're going to get to start the year, and it probably wants to try to push higher from here to next Wednesday. And then we'll see when we meet again next Wednesday whether there's more selling that's coming in, or exactly how we navigated through this particular area. But I think overall, again, if we are disciplined and we look for the right stocks, we should have pretty ample long opportunities over the next couple of weeks as the market tries to push the boundaries and see exactly where the sellers are. Now, let's take a quick look at the U.S. dollar index. You can see the U.S. dollar has really struggled over the last month. And, we didn't really get to meet for a couple of weeks because the last couple of Wednesdays were on holidays, right? We had Christmas and New Year's both on Wednesdays. So this is the first Wednesday webinar we've had in a few weeks. And we really didn't get to, the last time we met, the U.S. dollar was way up here around 26 on the UUP index. And as you can see, we've had a very drastic drop. This, of course, has led to very strong moves in gold and silver, which we'll get to in a minute. And the question now becomes, has the U.S. dollar found a stable level to sort of bounce and a new level that it needs to hold as support, or are we going to continue seeing a further drop? Now, for me, I think I'm more inclined to say that the U.S. dollar probably found support here around 26. And while it will probably come back and retest it a few more times, I think that we found probably a stable bottom here, at least for the next couple of months, or at the very least until our next FOMC meeting. And if that's the case, then we should start to figure out what the next range is going to be. Is it going to be from 26 to 20 or to 26.30 or to 26.50, or does it have the potential to come back all the way up to 26.75? I don't think it does. I think at the moment we are probably looking at a level around 26.37 as a ceiling for the UUP index. And if we look at the individual currency crosses, we'll see exactly why the U.S. dollar is behaving this way. So the first thing we want to look at is the euro US dollar.
Now this one is inverse to what we just saw in the UUP index, right? Because this is based off of the euro. And what you'll notice here is that the euro has gained some pretty steady ground versus the US dollar. And this is a big reason why we've seen the drop in the drastic move down in the UUP index, is because the euro has started to really pick up some momentum. Now, over the last week, it has pulled back, but you can see it's in a pretty fairly easy to recognize channel right now, right? Oh man, sometimes my mouse acts up on me here. All right, so you can see it's in a it's a pretty recognizable channel, right? It's at the bottom of that channel, so this is critical. Is it going to find support and hold? It looks like it probably wants to break through that channel, but we'll see. We'll wait and see what happens here. You can see volume picking up here. It could be that the euro has finally exhausted its move upwards and needs to come back and start testing a little bit lower. And if that's the case, that would coincide with what we're seeing on the UUP index, that maybe the US dollar finally found a bottom. And again, you can see the mirror move, right? The US dollar has gone up as the euro has gone down. Now, if you're a Forex trader and you're looking to trade, there is the potential for a bounce trade here, but I would not enter right now. This is there's too much strong downward price action over the last couple of days, and we need to see reversal patterns before we expect this channel to hold up. I think at the moment, from what we're seeing, it looks like we're probably going to breach that channel and test the 50 period and possibly have to come down to test this 110.70 area. But we'll see what ends up happening. Now, the key thing to notice here is that the euro did have a major move upwards, which put a lot of pressure on the US dollar as an aggregate. And while we have seen a reactionary move by the US dollar, the euro continues to establish what is now looks like a pretty clear bottom. And at the moment, looks like it wants to reverse the trend and start making its way upwards. Now, if we look at the US versus the Canadian, you'll again see the US dollar lost a lot of traction versus the Canadian. It's recently looking like it wants to find a bottom. It's not a good spot because it's below the previous low. And while we are seeing some pretty strong signs of buying here, again, it just shows that the US dollar is really losing a lot of critical levels and is really struggling. Now, at the moment, it is going to probably make its way upwards. It's probably going to make its way back to the 20-period moving average. And then we'll see. When it finds sellers again, and we see whether it comes back and it challenges these lows or whether it continues to make its upward trajectory, we'll get a clear idea of what the US dollar wants to do. But again, it looks like the US dollar at the moment is bouncing, but these are just reactionary bounces, and we can't tell if this is a dead cat bounce yet or the beginning of establishing a longer-term bottom. And then the last cross we want to look at is the US yen, and this one is a little bit different in that, you know, the US dollar has still sort of maintained a pretty decent trajectory upwards, but it you know, this was pretty big breakdown. We had a very nice inverse head and shoulders. We had to break above it, and it tried to push past this 109.5 area a few times. And this last drop, which coincided with the US dollar dropping across the board, we lost a very critical level here around 108.7. And while we're able to get past it today on pretty high volume, it just shows that the US, even versus the yen, is struggling. And again, I think this is more a function of the yen being weaker than really the US dollar showing strength. But even this cross, which the US dollar was doing very well versus, it's starting to struggle as well. And even though it has a nice strong bounce today, we'll see what happens the next time it comes up towards this resistance here around 109.5 or so. Now, what this means, of course, is that gold and silver have run rampant. Ray, if you're in here, I would hope that you've taken some profits finally on some of your long gold trades that you've held for very long times. You know, there is a chance that gold can continue upwards, but I think based off of what I'm seeing with gold and with the currencies, that the US dollar looks like it wants to at least try to stabilize here, which means that it will probably put some pressure on gold and silver, and we're probably going to need some consolidation here around these levels. So if any of you guys were long gold or silver, which I missed this move entirely, but for anyone that did try to play this, and again, the last time we met, gold and silver was in a pretty different place compared to where we are now. But for those of you that caught some of this move, you probably want to be taking some profits here. As you can see, volatility starting to increase. We're starting to see some selling pressure. And while I do think there is potential for a continued move upwards, there's also potential for us to kind of come back and test lower and kind of retest some of this breakout if the U.S. dollar gains more strength. So this would be a good time to take, at the very least, partial profits on these plays. Now, that being said, you know, where we stand right now, particularly on gold, on GLD, we've broken past our recent highs and we've moved upwards. So even if we do get some broad consolidation, you know, overall this is a pretty bullish move, and this is something we did watch. You can see I was mentioning when was a good idea to go long, and this is a discussion we've had several times over the last couple of months. And one of the keys was this break around 140. As you can see, we had this on there as a real big momentum shift. And of course, as soon as that broke, you know, it was basically we were off to the races. Now, despite the fact that risk reward is poor here, and we're seeing some you know, signs of volatility and some signs of selling, gold is on the right side of the price action now, which means that it's basically strong, and it's looking for sellers. So once we get a consolidation here, once we get a better pattern that gives us a nice entry, it could make sense to go ahead and re-enter and start playing to the long side. So despite the fact that I'm saying now's a good time to take profits, it's also a good time to keep this on our watch list and watch to see when our next possible entry can occur. And that might not happen for another few weeks, but you want to put these on your watch list now and keep an eye out to see when we get a pattern that would give us a better opportunity to re-enter, or you know, enter if you missed this move like I did. And then finally, the last commodity we want to look at is oil. Oil's struggling today pretty strongly, but it actually had a very strong move. A lot of volatility coming in, some of it due to unrest in the Middle East, some of it just because oil is finally starting to kind of blow out after this big move up. It's been in a very steady uptrend. It's kind of interesting because I had a lot of trouble with oil towards the end of last year, but when you look at it in hindsight, it was actually trading in a pretty orderly pattern. And if a lot of times what happens is when you have a channel like this, right, eventually you have that breakout to the upside, and when that happens, a lot of times the move, that's sort of like kind of like the blowout, where it gets ahead of itself and it tries to really accelerate past what the momentum it already had, and that's kind of like the blowout before it finally reverses course. You'll see this a lot of times in momentum stocks, not necessarily oil, but that ended up being the case here, and it's had a very drastic reversal. I suspect that the next time it comes back and tests this channel, it might try to bounce and then roll right back over. This is a pretty big reversal pattern. A lot of high volume, some really big moves, and I'd expect oil at this point to probably find buyers at some point, but more likely than not in the long term to start to break through this channel and start to head back down and maybe have to come back and retest the 50s at some point, the mid to low 50s. But we'll see. For the moment, there's not really a trade left. Just, you know, there's nothing I'd trade with oil right now because, again, you missed this rollover, which I probably wouldn't have taken even if I did see it. And at this point, we want to see how it behaves as it comes back to the bottom of this channel, the 20 period moving average, the 50 period, and see what it does around those levels. All right, so that covers it for oil, gold, silver, the stocks, the stock market. Let's go ahead and take a look at chart requests. Anyone else that's in here, if you want to take a look at, if you want me to take a look at a chart you're looking at, let me know. We're going to look at, first one we're going to look at is 3M for Wes. Now, Wes, let me know on these three if they are names that you are actually actively long on or names that you were looking to trade, and we'll try to figure out what's going on here. So you can see I've analyzed 3M in the past. It's been a while. Let's take a look at the weekly chart and see what it's doing and see where it is. And you can see it's actually coming up into some pretty stiff resistance, right? So I don't know that I'd be excited to buy this right now. Like the markets, it's kind of interesting, right? Because if you look at it, it's doing the same thing the markets are doing, right? You even have that same horizontal level.
right? So we're getting that same breakout the markets are getting, but that puts it in the same place as the markets, which is risk reward at the moment is not that great, right? Because you take a look at it, where are we going to put our stop if we try to go long here? And again, let me know. Maybe you're already long and you're trying to figure out whether you take profits, but I guess the answer is going to be the same anyway. We are pretty close to what was a pretty key level of resistance, right? If we go back, trying to make this line horizontal. If we go back and look at the weekly chart, we saw what, this is a price level that was pretty important. Way back here in 2016, this was pretty stiff resistance, and eventually we broke out, and when we did pull back, we found two levels of support. We found a level right below 200 at around 195, and then we had another level right here around 180, 181, right, where we found support, then we broke down, and then it became resistance, and now we've made our way all the way back up to that level, right? So here's the issue. If you're trying to go long, where's our stop? Right here, right? Where's our target, or where's resistance? We're at it. Now, if we could push past 182, well, then maybe there's a chance that we make our way to the next level, which was that area right around 195, right? But at that point, if we do break past 181, again, our stop is way down here on 174, right? So that's about 7 points. So we need a move of 7 points before we were at just 1-to-1 risk reward, right? And then move back to 195, which I think is unlikely at the moment, would be almost 2-to-1, right? So you said you're in, but you're only in a couple points on it. So you're only up a couple, right? So you probably entered on today's break. So here's the issue I have with it, right? Is that even if your stop was here around 176, right? And let's say you entered at 178, so you're looking at about a 2 or 3 point stop, right? We're basically at resistance. And unless it can blow through this resistance, there's a pretty good chance that it's going to spend a little bit more time trading sideways at this level, right? Yeah, I figured you meant only a couple points up. So the problem I have right now, Wes, is that, like I said, you need a breakout. In order for this trade to really be successful, you need this to push past 182, which is actually a pretty important price point. Now, the one thing you have maybe going in your favor is that it consolidated very nicely just below it, so maybe it has enough momentum to push past it. I think because you're already in this trade, you really don't have any recourse other than to try to wait for the breakout. What I do is I make sure that you are pretty quick on the trigger here, and maybe even lock in a little bit just to make sure you're safe. I don't know how big your position is, but this is a trade I likely would not have taken just because I would not want to be in the position you're in now, which is needing a breakout through pretty important resistance in order to have a really successful trade, because there wasn't enough upside in my mind. Now, of course, if your target is 195, then there's plenty of upside. The thing is, at that point, you need to be patient and you need to wait for it to push through there. And there's a good chance it can break through, right? If the markets continue to rally like they've done recently, then there's a decent chance that MMM has enough momentum to push through that, at which point we could probably look at a move up to about 185, 186, and then in the longer term, it could maybe make its way back to 195. But I don't think it gets to 195 until its next earnings, which is in 18 days. So it has earnings coming in about 3 weeks, and I don't think it pushes up to that range before that. I think that if it's going to make its way back to 195, it'll probably have to be through earnings. And if earnings are poor, of course, then that's going to be the impetus to make it not be able to really push through here. So you got 2 or 3 weeks to really make up your mind on what it wants to do. I'd have a pretty quick trigger on closing out this trade if it started to pull back below the entry. There's a decent chance that it's going to struggle at this range. I would say, if I had to ballpark probabilities right now, I'd say that it probably is 60 to 70% chance that it stays stuck at 180. And you probably got maybe a 30-40% chance that it breaks through. So, I mean, there's still a chance that it does, but more likely than not, it's going to probably struggle around these price points. But we'll see. Like I said, it did have a nice breakout through what was a consolidation range, and hopefully has enough momentum to push past it. And if it does, I'd be looking to take profits, at least partial profits around 185 to 186, and then you can hope that
it tries to run up into earnings. And, like I said, the market itself is at a point where if it starts to rally strongly, which there is a very strong chance it does, then names like this will follow suit, right? So, hold on and see what happens. But I'd be quick to close it if it started to go against me, just because it's at pretty stiff resistance for the actual equity. All right, let's take a look at Caterpillar. All right, so Caterpillar in a much different spot, more like the Dow Jones, which of course makes sense. So let's look at the weekly first. This is actually pretty nice, right? So if we look at what Caterpillar has done recently, this is pretty bullish, right? So we've got this longer term pullback, right? We've got the breakout, and now we've got the bull flag. So on a weekly chart, this is pretty nice, right? Now this bottom trend line is kind of just a gauge. It's not really that accurate, but this is giving you an idea of what's going on here, right? Now the one thing we do have a problem with is that it did try to break out and failed, but it did it in a pretty shallow manner. So now we go to the daily chart. We take a look at where we stand. We have a much better picture of what Caterpillar's trying to do here, right? So this is another one. You're currently up 12% on Caterpillar, so you've been up. You've traded it, I guess, down here. Maybe you bought it as it broke the 20-pair moving average. I think that this still has potential for a further breakout. If I was in this name, if I was up like you are, again, I don't know if you've booked any profits. For those of you that maybe, I think most of you guys are regulars, but for those of you that maybe there's someone here that isn't a regular, Twitch doesn't actually let me see the names of the people unless they type in the chat. If maybe you don't, my style of trading, I often, when I enter a trade, I will often look to lock up a third to a half of the profits off of my first maybe 1-to-1 or 2-to-1 as far as risk reward is concerned move, right? So if I'm risking, say on this particular trade, let's say I was risking 5% on a 5% move down. As soon as I move up 5 to 10%, I would lock in partial profits. I find that it's much easier for me to hold a trade for its full move if I've locked in partial profits. So a lot of times I'll recommend that whenever I'm discussing a trade with someone. I think that psychologically it's much easier on a person if they are trading from a position of advantage and have locked in some moves. Now, if you have a small account, it's difficult because that's more transaction costs, and you might not have a position big enough to lock in profits, right? You don't want to lock in $10 of profits if you're spending $5 in commissions or whatever it is. So it's not always the right move for everyone, but in these particular cases, if you count the move, say from 143 to 148, and it hit resistance, a lot of times I'll do something like that. If I catch a reversal down here, I'll look to book profits as we hit resistance, just in case it ends up rolling over. Now, not sure if you've taken or are looking to take profits on this, but one thing I will say, in the long term, this is looking pretty good. As you saw in the weekly chart, I think we had a big change in direction. We've got a nice consolidation range here, and while the risk reward is not fantastic on the daily chart, I think on the weekly chart this looks pretty good. And so it's a matter of, at this point, you're already in. It did fail the breakout, which is concerning, but as long as it doesn't negate this move and roll over and lose the 50 period, the 20 period, and lose this ascending trend line, which again is not that accurate, right? Because you could look at it as something like this, or you could look at it as something like this, and depending on it, that would make the bottom of this flag a little bit more difficult to really say where it is. So I wouldn't just say, well, if it breaks this trend line, maybe what we want to do is just identify this level here. But again, that's a long way to drop for you to worry about your trades. So I would say hold it, hope for a breakout, and then try to come up with a decision as to where you think that this is, what price it needs to break for you to say, well, I don't have confidence in this anymore. Whether it's a 50-period moving average, an ascending trend line, or if it's all the way down here. I think if it comes all the way down here, you're back to, you're not really you're not really up anymore. So you might not want to wait that long. But I think that this is setting up for a breakout, and I think this is setting up for a longer-term move. It's just unfortunate that this breakout didn't hold, but there's always a chance that it does again. You said you're willing to hold this one longer. China News has helped it back over. And again, as you can see on the long-term chart, I think that this is making its way higher. But a lot of times you have to wait for it to move slowly through before it starts to push upwards. But I do like this pattern, and I like this, and I think that there's a lot of upside here if it can push past 148 and of course 150. But I like this pattern. You just have to wait to see what happens as it figures out. Now that it failed that breakout, so it needs to try to break out again. And the last one is Dunkin' Donuts. And not doing as well as I thought. Alright, so let's look at the weekly. Starbucks was another name on my Patreon recommendations. So it's interesting because I've been watching some of these food names recently, right? And so Starbucks has had a nice move upwards. Like I mentioned before, Shake Shack started to move up, and of course Beyond Meat started to move up. But also, like I look at like McDonald's. McDonald's has been moving up recently, right? Yum is not quite the same, but sort of doing that same around the bottom. So I noticed a lot of these food industry names are starting to find these bottoms, these rounded bottoms, and that was part of what got me into something like this Beyond Meat trade on Monday, was the same pattern that I'm starting to see across the board. So I hadn't looked at Dunkin', so I was expecting a little bit more of a move similar to those, but not quite the same. Alright, so you're not currently in this one. Alright, so let's look at the weekly chart first and get a better idea of where we stand and what we're looking at, right? And so the last time I looked at it was when it was trading above those levels, and those were the two support levels that I was worried about. It lost them both, and at this point those should become resistance levels now, right? And I mean, in the long term it's still very, very strong, right? The question is, did this roll over, or is this just a stronger pullback, and is it getting ready to push past above it? It's pretty clear in the weekly chart that if you want to be long this, you want it to be above 77, right? So we have that. We know that. Now, I hesitate to draw a support level. I don't think that there's a good horizontal level. We could say that this here is, which of course makes sense because that's where it's found support, but we're not going to draw that trend line like that. We're going to put this down here, and then we're going to move it as we go to the daily chart. All right, so let's go back to the daily now. So here's the issue I have with Dunkin' at the moment, right? Short-term support is 73. Short and intermediate-term resistance is 77. This thing's right in the middle at 75, right? So if we want to trade this right now, it's stuck in a range. It's back and forth, and it's in the middle of that range. And even if we look at today's candle, you could tell it's stuck. It does not know where it wants to go right now. It could go up, it could go down, it could go in any direction. The only real thing we could say positive is that it already tested the bottom of that range, and it's coming up, and it almost tested the top of the range, and it came back. So I don't think this is worth trading right now. I think if you want to trade this, you either want to trade it at the bottom of the range again, and if it comes back to the bottom, it's probably not that great of a sign because it's already tested this 3 times, and it's already tested the upper levels like 2 or 3 times, and oftentimes that's how many times you get before a break, right? You get 1, 2, 3, and then a break, and it doesn't happen every time, but it's something that happens quite often. You get 2, 3, 4 tries, and then that's it, right? And so if I wanted to trade this, I think I'd want it to be above 77. I'd want to see if I could get another bounce to 73. It's a little disconcerting that it's not moving the same as the other food names I saw. And while it has gained, it has shown some strength over the last couple of weeks, it hasn't done much as far as moving past some of its ranges. So I don't see this as a good trade candidate at the moment. I don't think it has good risk reward. I think if you went long here, you've got very stiff resistance just a few points away. You don't really have a good stop unless it's way down here. and there's just not enough here for me to want to trade it in either direction really. So I would wait on this one. I don't think that this one really provides an opportunity for a good trade. Of the three that you mentioned, I think Caterpillar has the nicest looking chart as far as upwards momentum or potential. I think MMM actually would be pretty good if it could break through a pretty key level, but this one at the moment doesn't give me enough for me to want to trade. I think I'd rather trade some of the other names, that give us better risk reward. So that, like I said, I don't want to keep harping back to a trade that did well for me, because not every trade I take does well. But you go back and you look, if it's like this, you're looking at a reward of 88, right? And you're looking, when you entered, it's at 77. You're looking at 5 points of downside and 10 or 11 points of upside, and actually even further if you look at the gap fill, right? So it makes it worth your while to try to trade something like that, right? Even when we were looking at Amazon, the other trade I was showing you guys, it was the same thing. We were looking at, our stop was here around 1733, long was around 20 points, but you're looking at a massive 100 points of upside at the very least, right? And then we get to this one, and you've got 3 points of upside, or 2 or 3 points, and 2 or 3 of downside. So it's just not worth our while, right? So I hope that helps, Wes. Good job on Caterpillar and MMM. I mean, they're up on you, they're up for you, and I think there's potential for a move higher on them. You just have to be careful because they're at resistance, and they might take some time dilly-dallying around there, trying to find more buyers to push them upwards. Okay. All right, guys. I think that covers it for today. We've been at it for about an hour. If anyone had a chart request that they didn't want to type in, maybe they don't want to put it publicly, you can always email me, stockdarts@gmail.com, or you can message me on Twitter, or you can message me on our Discord chat, and I can always just send it to you just privately, or give you advice on whatever chart you're looking at, and let you know what I think about it. Other than that, hope you guys have a good rest of this week trading, and we'll meet again next Wednesday.